Okay, hi everyone. Second video here for chapter 24. We are picking it up with operating overseas, right? Um, we had tax reform, right? There were a lot of issues with international tax before, kind of complaints, issues. You may have heard like companies parking income overseas. They tried to fix this. In some ways it's fixed, in other ways it's kind of still screwed up. But essentially, in the TCJA, right, the Tax Cuts and Jobs Act, they had a lot of international tax provisions, right? So one of them is called the participation exemption, and another is called foreign derived intangible income. There's another called the BEAT, the Base Erosion Anti Abuse Tax. And then there's another called GILTI, right? Global Intangible Low Tax Income. We're going to talk about some of these here, but again, there's a lot of different provisions, 4 or 5 big things that came from the TCJA that now has like sort of really rocketed international tax into a very important area in planning. So with regard to the participation exemption, right? What is it, right? It's a DRD, right? A type of DRD. And essentially what it says is this, right? If you have income overseas, right, through a foreign corporation, one of the things we'll talk about is, right, as a general rule, you don't claim that on your US tax return until you like physically bring the money back here, right? Repatriate it, right? That's the idea with it. And what was happening, right? Well, like a lot of companies were just sitting on money overseas, right? They weren't bringing it back because they didn't want to pay the tax. So in comes this participation exemption, right? That basically says, look, if you do repatriate this money, right? Say you bring back 500 grand of income, you repatriate it, we will give you a 500 grand deduction on your tax return, right? Which essentially makes it tax free. Now there are, requirements for this participation exemption. You can read through them there, right? The foreign corporation, that X, right? That has to be owned by at least 10% US shareholders. They must have owned the stock in X there for more than 1 year, and you're not going to get any foreign tax credit or deduction associated with taxes paid with respect to a dividend that qualifies for the participation exemption. So let's look at a setup here, right? America Corporation, right? Here we go. That's great, right? Here they are. They own 100% of Canada Corporation, right? So it looks like Canadian Corporation, right? They have $1 million in profit, and they pay that back as a dividend to the America Corporation. Well, looks like they meet the requirements here, right? Canada Corporation over here, they're owned by 10% US shareholders. They own the stock for at least a year. Accordingly, right, when they bring it back, they're going to have to claim $1 million of income, but they're going to get $1 million dividends received deduction, which effectively makes that tax-free, income tax-free. Okay. And again, they created this as an incentive to have people, not just park money overseas. So that was one thing they did in tax reform, right? Another thing they had was this FDII, right? It's foreign derived intangible income. So it's a type of income, right, which is meant to encourage US based operations for the development, sale, and maintenance of intangible assets to foreign customers. In other words, what we want to have happen here is basically, hey, instead of having all your intangibles overseas, let's create them here and encourage you to sell them, internal to the US and outside of the US, right? We want US based operations for the development, sale, and maintenance of these. intangible assets, right? So if you have income from this, right, foreign derived intangible income, right? So it's foreign. Really what we're getting at here is US based operations, so that's why I have it in there, but it's really foreign derived intangible income. What happens here is you're going to get a 37.5% deduction for that income, which when you factor in the deduction, right, you run the math on it, that's going to produce an effective tax rate of 13.125% on FDII, right? So what's going on here? Hey, you sell stuff normally in the US, right? You're going to have to pay 21% tax to encourage you to like kind of have your intangibles and produce them here. Effectively, you're going to pay 13.125% tax on it. That's the idea with FDII. It's a type of income. To encourage that from like a policy perspective, we're going to let you effectively pay a lower tax rate, 13.125. How we get you there, that effective tax rate is a 37.5% deduction. Okay, we'll run through the slides, then we'll look at the Excel problems for this after we build it out. All right, tax treaties, right? So a tax treaty is essentially an agreement between two countries to modify their tax laws. Really, why we create these for a couple reasons: to help avoid double taxation, to make things more efficient, effective between countries, right? Now, one of the things you got to be aware of is a permanent establishment, a PE, right? So say we have, the United States and, right, you're going and operating overseas in Germany, right? There may be a treaty between these countries, right, Germany and the US, and in that treaty, they spell out, right, what constitutes a permanent establishment, which basically says how much activity do you need to be doing in Germany before it rises to the level of being taxed, okay? And traditionally, right, the level of activity, what is a permanent establishment, right? Well, normally it's going to be having a fixed place of business in the country or operating in that country through a dependent agent, okay? Now, it says here, even with the 100% DRD, right, that participation exemption, individuals and businesses may still have leftover foreign source income subject to U.S. taxation, right? To mitigate this, we have the foreign tax credit, right? The one thing with this is when we have the foreign tax credit, it is for foreign income taxes, not every other single tax in the world that you pay over there, right? You only get it on foreign income taxes. And we said you got to calculate it 4 separate times, one for kind of each basket, right? You got to take your income, put it in the general basket, the passive basket, the foreign branch basket, and the GILTI basket. Now, the organizational form, the way by which we operate or, overseas, it can kind of take a couple different forms here, right? Say we are here in the US, right? We're getting bigger and bigger, we're growing, right? We're like, look, we want to open a store in France, right? We want to start beginning operations overseas, right? We see some customers, some demand there. Really, there's 2 ways you can operate over there. One is through a foreign branch, and another is through a foreign subsidiary in it. A foreign branch is essentially just going over there and operating, right? We're going to open a store, that's great. A foreign subsidiary is when we basically go and create a separate legal entity under French law and operate over there. And one thing to be aware of here is that U.S. tax laws, right? If you were to create a foreign subsidiary, right? So say we have like parent company and then we create a French sub, right? To operate over in France. They will have, again, we've talked a little bit about this, like default rules for how we're going to tax this guy, right? But we can check the box on it to choose the way we want to be taxed, assuming we meet like the rules on that. So we said, hey, you're operating overseas. There's two ways. One thing you can do is open a branch, right? So here, right, an offshore office or facility owned by the U.S. corporation that is not its own legal entity under the foreign country law. Really, this is just considered an extension, right? It's like a branch of a tree almost of the U.S. corporation. It will normally constitute a permanent establishment and be eligible for treaty benefits. If we open a foreign branch, right, we're going to be subject to tax in the U.S. on the net income. And we could potentially get some foreign tax credit on that. So it's kind of taxable now, right, if we open a branch. So what would be an example of this, right? We have a U.S. corporation. They open a sales office in Brazil for sales to Brazilian companies, right? They don't form a separate legal entity over there in Brazil. They just open up this office. There they go. That's going to be a branch. Any net income from that branch is going to be taxable to us, the U.S. parent company. In distinction to a branch, right, we can open up a foreign subsidiary, right? So this is going to be a separate legal entity incorporated under the laws of the foreign country. One of the things here is we can't file a consolidated U.S. return with the parent company. U.S. income is generally going to be deferred on foreign subsidiary income until we repatriate it back, right? We bring it back. We did talk about that participation exemption if you qualify. And to the extent it has U.S. source income, it's going to be subject to U.S. taxes. The general rule is we defer, right? Hey, we open up a French, we create a French corporation. It's doing its own thing over there. Unless and until we bring that money back, we're not going to tax it in the U.S. as a general rule. Now, if that French company comes and they start selling croissants here in the U.S., right now that's U.S. source income, right? That'll be taxable because it's U.S. source income. But the stuff they're doing in France, right, as a general rule, we defer it, taxing it till we bring it back. And when we do bring it back, right, assuming we meet, certain criteria, we can get 100% dividends received deduction for that, right? So what would be example of a foreign subsidiary? Right, so a U.S. corporation creates a separate Brazilian corporation that opens a sales office in Brazil, right? Because we created that separate legal entity, now it's going to be a foreign subsidiary. So the subsidiary is a little bit more formal. It's a little bit more legal. It's a separate legal entity we're creating. Like anything, there's good and bad with each of these, right? The branch, what are some of the good things with it, right? Well, foreign losses are going to be deductible on the U.S. return. Foreign taxes paid, we can get the foreign tax credit for. It's normally going to constitute a permanent establishment, which can kind of hook us up with treaty benefits. What's the bad, right? Well, it's going to be taxable now as a general rule, right? The income, right? That's not a good thing if we got to tax it now. Well, if we have a loss, right, we said we can utilize that loss. And what's a negative? Another one, it's got to be 100% owned by the U.S. parent. In other words, we can't have a joint venture here. Foreign subsidiary, right? That more kind of formal legal one. What's the good? What's the bad? Well, hey, you could get the DRD, the participation exemption on that. Payments from the foreign sub to the U.S. parent may qualify for a deduction. Foreign corporate structure can protect the U.S. parent against certain liabilities, right? So from a legal standpoint, hey, it's a separate corporation. They can't really get to us in the U.S. It gives us some legal protection. What's the bad, right? Losses are not deductible on the U.S. return. And the other bad is, right, certain foreign income could be taxable now, right? So subpart F income or GILTI, which we'll talk about, you could be taxable now on it. One thing, right, I told you with international tax, there's a lot of planning, right? Like how do we want to structure our organization overseas, right? So we may have like parent company here in the US, right? That's a rectangle as a corporation. If we want to open up a French corporation, right, it would be a rectangle, right? It might be like French down there, a subsidiary. If we opened up a German partnership, right, it would probably be a German, a triangle on here. I do this because if you actually go work in IT, international tax, they have kind of a framework here for if you look at what's going on, at an org chart and you're planning, each of these things, means something. There's kind of like a key or a mapping, shapes you use on an org chart to convey certain things on there. Likewise, there's kind of like action items, right? So like when I've done this before, like if you're like mapping out like an M&A thing or you're creating a deck, right? If you wanted to show like step 1, parent opens foreign subsidiary, right? If I was like explaining this like step 1, step 2, step 3, right? Step 1 might show a dotted line, right? Like that is conveying that, hey, we are doing something, right? It's showing like action if we were like mapping this out. So I show this to introduce it to you. You could see it in normal practice, but be aware, right? Org charts and stuff like that, you may look at it in practice. Okay, so we said, right, that when you're operating overseas, that you have, a branch that you can operate through, or you can do a foreign subsidiary, right? One type of foreign subsidiary is called a controlled foreign corporation, a CFC. Why we care about this, right? So what is it? It's essentially, okay, here's the US, right? We open up, right? We're parent company over here. We open up French company. We own 100% of that. That is now considered a controlled foreign corporation, right? We own all of that. One of the things, right, we talked about is as a general rule, right, foreign corporations don't, if they make income over there as a foreign subsidiary, they don't pay tax on it until they repatriate it, right, unless and until they bring it back. So what was happening was they weren't bringing it back, right? They were just leaving it over there. They were parking it. So among other things, right, they say, well, when you have a foreign subsidiary and that type of foreign subsidiary is a controlled foreign corporation, we are going to create something called Subpart F and GILTI, which says, hey, if you just sit on it over there, we are constructively going to treat it as if you brought it back. That is to say, depart from that deferral rule and tax it now, right? So these are anti-deferral rules, not letting you park it overseas, make it taxable now. Okay, so we're talking about a CFC because these rules, Subpart F and GILTI, are going to generally apply to CFCs. What is a CFC? So it's a foreign corporation in which on any day during the tax year, U.S. shareholders own more than 50% of that corporation. What is a U.S. shareholder? Right? Well, a U.S. shareholder is somebody who owns, right, it could be an individual, partnership, corporation, estate, or trust, 10% or more of that foreign corporation. So what's going on here? Step 1 is you got to look at the foreign corporation, right? So let's just say there's a French corporation. And if we look at the owners of this, right, maybe we got one guy who owns 15%. We got one guy who owns 50%. We've got one guy who owns 5%, right, so 20. And then we got one guy who owns 30%. first thing we got to do is who owns more than 10%, right? So they own more than 10, they own more than 10, they own more than 10. Sorry, right? You don't count, right? Then we say, okay, of these people, right, are they U.S. shareholders, right? Maybe this is a U.S. individual, right? Maybe this is a U.S. corporation, right? Maybe this is a German corporation, right? Well, they're not going to be a U.S. shareholder, right? So then what we say is, okay, these guys are both U.S. shareholders, that is to say they own 10% or more. Then we say, do they collectively own more than 50% of that foreign corporation? If yes, step 2 there, right? They collectively do 15 plus 50, they're at 65. That is now considered a controlled foreign corporation. Typically what you'll see, right, is like you'll have a U.S. parent company, right, in the U.S. They'll own that French subsidiary 100%. Well, that's going to be a CFC, right? The idea for that is, hey, it's 100% owned by a U.S. shareholder, a U.S. corporation, right? It can be a U.S. corporation. There is a U.S. person. So we'll come back to this when we look at the examples on there. So we said with, let's say we have a CFC here. The general rule is unless and until they bring it back, right, we're going to defer, right, the income, right? But once they bring it back, it's taxable. If they qualify, they could get a dividends received deduction for that, the participation exemption. 2, discourage companies, right? They don't want to bring it back, right? They want to just leave it over here, right? And just kind of park the earnings. We have a couple provisions that are anti-deferral, anti-parking. One of them is called subpart F, right? Why it's subpart F is it's basically that is the provision or the area of the code, right, that deals with this, that talks about this. And essentially it applies to CFC US shareholders, right? So, hey, you parent company in the US who owns that French company, you are a CFC US shareholder. And it says CFC shareholders who own stock on the last day of the taxable year end. What happens here is, hey, we look at their income over here. If it is subpart F income, then we immediately make it taxable now, right? You do not get deferral on it with it. So what is subpart F income? We know it applies to CFCs, right? And it makes it taxable now. Well, essentially it's complex, right? There's a lot of different provisions, but the main type of subpart F income is this foreign-based company income, right? Which is an umbrella term, right? So FBCI, right? There's kind of 3 different categories with it. So we're talking about subpart F. We said the main category is this FBCI. And internal to that, right, there's 3 subcategories, right? We have 4, this is the most common right here. Foreign personal holding company income, it's generally going to be passive income. In other words, if you have a CFC that has, right, so here's the CFC overseas, right? If this thing has income from dividends, interest, annuities, rent, royalties, gain, right, basically passive income, we're going to make it taxable now, right? That's generally when people think of subpart F income, they think about like a passive income. That's the most common. The next one here is foreign-based company sales income. They all sound the same, but they're different here. Okay, so this is when the CFC has income from the purchase or sale of personal property, right? So the sale of personal property to or from a related party when the property is manufactured or sold outside of the CFC's country of incorporation. Then we have foreign-based company services income. This is essentially CFC income from the performance of services for or on behalf of a related party when the performance of services occurs outside of the CFC's country of incorporation. So this one is basically for like inventory, selling inventory. This one is performing services. We will come back to these two whenever we go through the Excel examples with it. For right now, just think subpart F income, FBCI. Main type is this foreign person holding company income, aka passive income, right? Why do they do this, right? Why do they make it where it's, if you have subpart F, right, it's going to be taxable now, right? Well, it's an anti-deferral rule, right? First off, it basically does make it taxable now. You can't park it. But really what they're saying here is we're not going to let you use the general rule, that is to say, unless and until you bring it back, it's taxable, as a weapon. In other words, in all cases of FCBI, the underlying income could have been earned without use of a CFC. In other words, look, right, you have $1 million of income right over here from the CFC, right, that passive income. There is no reason, right, why you could not have just bought the stock or the bonds here through the parent company, right? We're not going to let you, basically sit on this passive income over here that you could have earned in the US. We're not going to let you use this as a weapon, the deferral rule, against us. So we're going to make it taxable now, right? And when we talk about, right, you have $1 million of income, the general rule is going to be that all $1 million is taxable in full. However, there are exceptions, right? So general rule is fully taxable, right? However, we have 3 exceptions to this that can modify it. So the de minimis rule says this: if the foreign-based company income, right, the subpart F, is less than the lesser of $1 million or 5%, then none of the FBCI is considered subpart F income, right? So I'm just going to put none of it. So hey, we have this CFC over here, right? Let's just say they have $10,000 in passive income, right? And let's say their gross income is, 10 million or something, right? In this case, right, this is going to be de minimis, right? It's just so small, right? $10,000, even though it is subpart F income, right? We're going to just say, look, right, none of that is going to be subpart F. It's too small, right? So that's going to depart from the general rule of it being fully taxable, okay? The next one here, right, is this full inclusion rule, okay? And this says, look, right, say you have sub 10K of subpart F on here. This says if FBCI is greater than 70% of the CFC's gross income, right? So let's just change the facts a little bit on this. Let's say this CFC has gross income of 10 million, of which, let's say 8 million is subpart F, right? So you would think, okay, 8 million, right? That's going to be taxable now, right? That's true. That's still the case. However, right, because, right, your foreign-based company income, your subpart F income, is greater than 70% of your gross income, the 10 million, we're bringing back all 10, right? This whole shooting match, that is to say your subpart F and your non-subpart F income is fully taxable, right? So this is all, right? So subpart F and non-sub F. Because essentially you're using this, CFC as a, a shell company almost. And then finally here, right, the higher tax subpart F rule says, look, a taxpayer can exclude higher tax subpart F income, that is to say, income generated by a foreign country at an effective income tax rate greater than 18.9%. That is to say, 90% of the 21% US corporate tax rate. What does this mean? Right? So say you have a CFC over here, right? And you're like, look, they have 8 million in sub F, right? You would think, right, as a general rule, right, we got to bring back all 8 million, it's taxable now. That's correct. That is correct. However, this exception says, look, if you are already paying, let's just say this foreign in France, right, you may be paying a 30% tax rate on this, right? In that case, you're not really using it as a weapon, right? Because you're paying more tax over there. If this is high tax rate, right, there's already a high tax rate, at least they're taxing it at 18.9%, then all of this you can exclude, right? None of that subpart F is taxable, okay? So that's subpart F income. It's complex, it's messy, it's ugly. We said that, right, it applies to a CFC. If they have subpart F, they bring it back now. The next thing is going to be GILTI, right? So GILTI is a type of income. It's complex how they calculate it. Essentially, one of the things is they say, hey, to the extent you, CFC, have GILTI income, we're going to make it taxable now. This is in addition to subpart F, right? So it kind of follows that framework there. It says the goal of GILTI is to subject CFC income other than subpart F. It's going to make it subject to tax if it exceeds a normal rate of return. It's complex, the calculation on it. In short, what you need to know of with GILTI is it is a special type of income that is designed to immediately tax the CFC's foreign earnings. Right? How much, right, of a GILTI inclusion, right? So say we have like a U.S. parent company with the foreign CFC, right? If they have GILTI, right, a type of income over there, it's essentially, it's like we set a rate of return, and to the extent you exceed that, that is now taxable. Right? How much of it is going to depend on the type of U.S. shareholder, right? So a CFC, it's owned by a parent corporation, that box, right? Or you could have a CFC that's owned by a U.S. individual in part, right? If it's a U.S. individual, right, say you own shares of this CFC, right? They have GILTI income. It's taxable to you now. Right? How does this work? Right? Well, you include your pre-tax share of GILTI income in your income. You're taxed on it on your federal rate. You don't get any kind of credit or deduction. In short, it's income to you if you're an individual. If, however, right, let's say it's a parent corporation that owns the CFC, right? They're going to include their pre-tax share of GILTI and income. They're going to get a 50% deduction for the income, which effectively makes it subject to a 10.5% tax rate. And they're also going to get an 80% foreign tax credit on any GILTI foreign taxes paid. So a little bit more beneficial or generous here for corporations. Okay, GILTI is complex. Like unless you're going into international tax law, I'm more concerned with like the basics on that. Finally, here let's talk a little bit about BEPS. Right, so this is the Base Erosion Profit Shifting Initiative. Right, so this is through the OECD. Right, so the OECD is like the whole world. Right, it's all these like countries. Right, and it's just like kind of a crappy depiction of the world they're drawn. But essentially, all of these countries who are members of the OECD have come together and created this BEPS initiative. It's like a really big deal, right? This is like if you go and you talk, especially to like a big four firm, and you're like, "How are you guys planning for BEPS?" Right? They're all on top of this thing. And what's the idea with BEPS, this initiative? Right? Well, essentially, remember we said right here in the U.S., right? If you have a foreign subsidiary, right? You're going, a lot of times they were parking money overseas, right? Um, and essentially this was like a loophole almost. So what we were experiencing here in the US, all these other countries were experiencing as well, right? In other words, like there would be, it's basically like one or two bad apples ruins it for everybody, right? You might have some like island or something down here that has a 0% tax rate. So like everybody is like parking income over there, and they're all kind of like saying one or two bad guys, right? Countries are ruining it for everybody else. We're losing our tax base. In other words, right? Like whenever they talk about profit shifting, base erosion, right? It's like, look, maybe our tax base here is like 100 billion or something, right? Or trillion. If we start having people just move the income, shifting the profit overseas in these kind of 0% tax rates, right, we're losing some of our tax base. It's eroding our tax base. Now maybe we only have 60 billion, right? So this base erosion profit shifting, where people are doing this, that's the idea here with BEPS. All of these countries, a few bad guys are ruining it for everybody else. And it says the goal of BEPS is to provide governments with solutions for closing the gaps in existing international rules that allow corporate profits to disappear or be artificially shifted to low or no tax environments where there's little or no income activity. It's just like you're on paper, you're there. It's estimated, right, that governments around the world lose between 100 to 240 billion per year in tax revenues from these actions. So under BEPS, right, the OECD has essentially laid out a 15 action plan, right, that's going to focus on things like transfer pricing, harmful tax practices, treaty shopping, transparent reporting. And the big thing here, right, is this kind of framework, this two-pillar solution that has pillar 1 and pillar 2. Right, so essentially with the digitalization of the economy, buying and selling things online, right, we've been experiencing issues with countries kind of like not collecting appropriate tax revenue from this. So pillar 1, which is kind of freestanding, it's much more established, right? What were they trying to do here with this? Right, well, this shifts tax revenues to countries where companies sell to customers as opposed to where the companies are located, right? So they're really kind of getting into, looking at the substance over the form of these sales. Pillar 2, right? This is like a much bigger lift. This is what they're currently working on. Like everybody's like, how are we going to do this? Right? Essentially, what's going on here is they are trying to establish a global 15% minimum tax, right? In other words, we don't want these one or two bad apples with the 0% corporate tax rate ruining it for us, right? So all of the OECD countries, right, they're kind of like, look, we need to band together, right, and stand up to these bullies. At minimum, all of us are going to have a 15% tax rate. And oh, hey, you over here, you want to be part of this group, right? You're now going to have a 15% minimum tax rate. It's kind of like everybody standing up against a bully, right? It's almost like if you ever were driving a car, right? Obviously, we all drove cars, and there's like a traffic jam, right? And you have all the cars here, and everybody kind of needs to merge into this lane. You may get some asshole, right, who like drives up and they try to get in, right? If you've ever seen this, right, it's kind of cool when these guys all band together, right? And they're all like, right on top of each other and they don't let the guy in. That's kind of what Pillar 2 is like. We're all trying to come together to stop this bully who's coming in. And when I say bully, right, like these countries over here, like these like 0% tax countries, a lot of them are like poor countries. So like this is like the only, like, better to get a little, like 1% or 2%, or even just on paper get you here, and then maybe we get some of your business, or be associated with you, right? I mean, they're trying the best with what they got. So I don't want to say they're bullies in the sense like they're trying to do this for their own self-interest, but it's the best they got with it. But that's the idea here with international tax. Let's look at some of the examples over here, right? So 24.8, right? We have like maybe 6 or 7 examples here. Maybe take 10 minutes, look at this. This is just looking at breaking out that advertising expense between the US and foreign source income. Again, another expense here. This is the one with interest expense, right, where you got to look at your average. So remember we said the general rule is you like apportion or and then you allocate, right? There's like, two steps with it, like match it and then divide it between the bases. We looked at the one with like the interest expense. This one is just, or the general like advertising expense. This is saying when you're dealing with interest, you have to compare your average tax book value to your total assets, right? That helps you break it out, apportion it, that $10,000 expense between the two of them. Instead of looking at the income, you're looking at the book value of the assets. Okay. This one talks about the participation exemption. Hey, you have that foreign corporation, they pay back 10 grand. You'll report it as income, but you'll get a 10 grand deduction to encourage people to bring back money. This one, right, they're talking about FDII, right, that foreign derived intangible income, right? We are trying to encourage companies to create and produce intangibles here and sell them overseas. It's a type of income from that sale, right? What we do is we give you a 37.5% deduction, right? So here they must have had $21,000 of this type of income. And when you run the numbers on it, because you get that deduction, it produces a 13.125% effective tax rate on that income. So again, would you rather pay 21% or would you rather pay 13% on your income? To encourage people to do this, right, we pay 13%. This one here, they're talking about a permanent establishment, right? Well, if you open a branch in a foreign country, that's going to probably rise to the level of being taxed there under a treaty. If you just were to ship goods from overseas, right, we ship it here to Italy, probably not enough to be subject to Italy taxation. In other words, that doesn't constitute a permanent establishment. This one, you can look at that. U.S. resident, not really concerned with that. Again, another resident question there. This one here, right, they're talking about the foreign tax credit, but remember, you got to do that for each type of income, right? So we have our foreign branches, right? We look at all our income from our foreign branches, and we calculate a foreign tax credit for that, right? Branch 1, 2, 3, 4, internal to that basket. Hey, we look at all our foreign passive income, right? We're going to have a basket for that, okay? This one you can look at, right? Why might you operate as a branch? Why might you operate as a foreign subsidiary? Then they get into a little bit here with CFCs, right? So a CFC is a type, a special type of foreign subsidiary. This one, right, it says a U.S. person is a 50% shareholder in a Canadian corporation. Is this a CFC? Well, no, it's got to be owned by more than 50% U.S. shareholders. Here there's a U.S. shareholder, but they only own 50%. Remember we talked about that step one, find the 10% owners. Are they U.S.? Step two, does the people that we whittle down step one from own more than 50%? So here, right, we have a 33% owner, a 33% owner, and then a 34% owner. They all own more than 10%. This one is US, that one is US, that guy's Canadian, right? In that way, right, it's 66% owned by US shareholders. Therefore, it would be a CFC on this. They do use those constructive ownership rules here, right? Where they can like kind of constructively, what you directly own and indirectly own, that can, be applied here and is applied here in the CFC framework. Then they talk about, right, subpart F income. Remember we said it's subpart F is a type of income from a CFC and it's taxable now. The main category of subpart F is this FBCI, right? We said there's kind of a passive type. And then we said that there's two other types, one related to like the sale of inventory and one related to the performance of services. All of these, right, why we do this is you're basically using the deferral rules as a weapon, right? You could have earned this income here in the US. This one here, right, it's looking at, so it says a US corporation has a Canadian CFC. That Canadian CFC buys stock in a UK corporation and they receive a dividend, right? They're going to have passive income, right? This is FBCI, specifically FPHCI, that first basket. It's passive income. You didn't need, right, this CFC to buy that UK stock. You could have just done it through the parent corporation, right? We're going to make it taxable now. The second one here, and let me see if I can copy this. I guess I'll just redraw it, right? So we got subpart F, main type is FBCI, right? We said there's like passive, which we looked at. There's inventory, and there's services. This example, right, it says a U.S. corporation has a Canadian CFC and a Cayman Islands CFC. So there's two CFCs here their own, right? There's parent corporation in the U.S., right? They own a Canadian corporation and they own a corporation in the Cayman Islands. Here's what they're doing, right? What they do is step one, parent, right? We'll put the little action line there, right? They sell goods to, not the Canadian, they sell goods to the Cayman Island CFC at low prices, right? Really low prices. So in the US, right, they have low income and they pay less tax, right? That's good for them. Then what happens is, right, they have the Cayman Islands CFC resell the goods, right? So there's kind of step one, step two, right, to the Canadian CFC at high prices, right? So we have basically all of our income here in that 0% tax jurisdiction, right? More income in the low tax jurisdiction. Is there subpart F income? Well, essentially, yeah, we're going to have this inventory, this FBCSI, namely the sale of property to a related party CFC when the goods are manufactured outside of the CFC country, right? So here, right, the goods are manufactured, let's just say in the US, right? We sell them from the parent to Cayman Island, then from Cayman Island to Canada, right? What's going on here is we're basically abusing these rules, right? We're taking, the income, we're making, like, let's just say there was $1 million of profit to be had from this, right? What we're doing is essentially saying, oh, okay, maybe we'll just claim, 100,000 of income here. And then we're going to, by virtue of doing this, put $900,000 of income here and pay zero tax on it, right? What we really should have done, right? And what, you don't need this intermediary to do this, right? That's all kind of bad, right? We should have just sold it to Canada to begin with, just like in the last example, we could have bought the dividends ourselves or got them ourselves, and we should have had all 1 million of it be taxable now, right? That's the point of this. You can't use it as a weapon. That CFC setup on there. And then this one is the same thing here. Let's see here, 2818, except the CFC is gross income of 125. Is there subpart F income? However, right, one of the things we said is, right, the general rule is, right, if you have subpart F, right, all 125K is taxable now, right? That's the general rule. However, one of the exceptions we looked at says, look, if this is de minimis, right, it's a relatively small amount, right, less than like $1 million traditionally, then look, we're not going to claim it now. You can just park it over there, not a big deal. Okay, so that's the lecture here. I'm going to end it on that.